Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Real estate investment trusts, REITs, a vehicle that allows common investors like you and me to participate in the rapidly growing commercial real estate sector in India. I'm talking swanky, large grade A office spaces, mega campuses which are being rented by top dollar MNCs who are, of course, operating their big, large global capability centers here in India. And then, of course, there are, swanky malls, warehouses, and now even the data center promise. All of this is likely to boost non-residential real estate in a big manner. At least that's what the industry estimates are saying right now. So here are some numbers. From less than a market cap, a total market cap of less than 1 trillion USD, to be more specific, we're talking about 0.3 trillion USD. The Indian real estate sector, according to estimates of a lot of the consultants and CII itself, it's expected to scale up to a level of $5 to $10 trillion by 2047. That's the Amrit Kal dream. This means from accounting right now to about 6 to 8% of Indian GDP, the sector can potentially start contributing anywhere between 15 to 20% of India's GDP by 2047. Now, those are big numbers. So REITs do allow us ARM investors to be a part of this mega transition. SEBI has also given this instrument a more favorable play from a regulatory perspective. So is it really time to give REITs a very serious look when it comes to our portfolios? That's exactly what we discuss on this show. And to help us demystify this investment class, we have today Vishal Dhawan, founder and CEO at Plan Ahead Wealth Advisors, as well as Ashish Shankar, MD and CEO at Motilal Oswal Private Wealth. Gentlemen, thank you so much for joining in. You know, a couple of months back, we did a very basic primer on REITs on Let's Talk Money. And at that time, I must say, REIT prices, just if you map the one-year chart of some of these listed REITs, they hadn't run up. But now we're talking, 20% plus in most cases. What's really going on? Ashish?
Yeah, so I think, Surabhi, it's important to sum up what's happened in the last 1 year. And in that context, how should people look at allocating their capital? It surely is becoming a very important asset class. And I think it's a very opportune time we are doing this for your viewers. So REITs, simply put, is fractionalization of commercial real estate, rented commercial real estate, right? Because if you directly go to buy a commercial real estate, it costs a lot of money. I mean, it could be in the region of 10, 20, 30 crores, right? Now, this REITs allow retail investors to own units of a large pre-leased commercial property, right? Now, secondly, people should not rush in to buy these REITs just because they've gone up 20, 30% last 1 year. They're not exactly equity shares, right? Yeah. They own income earning assets underlying the structure. So let's understand what are the three components of the income, right? First, all these REITs are supposed to have minimum 80% of income earning assets, right? So they get rent out of these assets, which are basically leased out by software company, GCCs, or any other commercial establishments. That is point number one.
So REITs earn from that rental income, first
That's
of all.
right. That's right. Second, the rules say that 90% of the net distributable cash flow has to be given back. So there's certainty that the money is coming back to you as well, right? So there is a certain income yield on REITs. That is point number two. Point number three, right? There is an escalation in rentals which happens every 3 years. So it's generally 15%. So to that extent, the capital values of these REITs also get re-rated.
Okay.
So broadly put, I'll just explain the maths. Let's assume a REIT is earning a rental yield of 7%, which means if the REIT is valued at 100 rupees, 7 rupees is the income, right? Now, if the value of the rentals go up by 15% every 3 years, then the capital value of the REIT should also go up from 100 to 115.
15%.
Right?
Yeah.
So essentially 7 plus 5, 12% is the base yield from the asset that you can expect to get.
Okay.
So that is the base yield. But now there is another...
This is over a 3-year period.
This is over a 3 to 5 year period.
3 to 5 year
right?
period. Okay.
Now let's come to the second component of the return. What often happens is, like bonds, right? Depending on where interest rates move, whether it goes up or down, the capital values of REITs also go up or down. Because you can pay more for the same asset if interest rates are lower, or you will end up paying less for that asset if interest rates move up, because your expectation of yield changes basis what the interest rate is at that point in time. Because if you go to an FD, let's say in an FD, if you're getting 8% and in a REIT you're getting 7,
Yes.
REIT is arguably a slightly more risky asset class because it's volatile. The prices are
Absolutely.
volatile.
Yeah.
Right? So
Yeah.
you'll go and
Yeah.
put money in the fixed deposit.
Okay.
You will expect 9% from a REIT.
Right.
Similarly, if let's say the FD rates or the interest rates prevailing right now go down to 5 or 6%, you'll be willing to buy the REIT at a 7% yield. So the prices move up of the REIT when interest rates go down,
fall. Okay.
and vice versa, right? So that's something in a technical parlance is called cap rate compression.
Okay,
right?
lots of technicalities. But I think
Right.
what you've explained is this is really important because that capital appreciation part is not very well understood.
That's
Largely speaking, when interest rates are falling, REITs are supposed to do better.
Do better. So three components of returns we discussed. One is the income part. Second is growth in the income, which is the reset of the rentals.
Yeah.
And third is the capital appreciation. And then there are some minor nuances. Every REIT also keeps adding, inventory and, your returns keep going up. But broadly, these are the three components that one has to be very careful. So now in that context, last 1 year, the capital appreciation has been
20%,
extremely
25%.
good.
These REIT units, by the way, if you look at, when you can do this, simply go online and look at 1 year returns from these REITs. And there's so many of them, right? There's Brookfield, there's, Mindspace, so many of these REITs, 5 REITs actually, which are now listed in India. If you plot a 1 year chart, then the gains are anywhere between, I think, 15 to, more than 15, 20%, 25% in some cases, right?
Right. So making an entry right now into these REITs, one has to be very careful in terms of what your expectation. Because the more the REITs deliver upfront, the back-ended returns tend to taper off.
That's a very important point, and we can only say this. Of course, investors will do their own thing. It just reminded me of the gold ETF flows. I was looking at the data that came out yesterday, right? In the months when gold was going through the roof, September and October, gold ETFs got the maximum amount of money.
Absolutely.
Because as investors, it's just behavioral sciences. I think we end up chasing returns. But Vishal, come in on this. So, Ashish has explained just the basic structure of how that REIT works. What has the experience of the past been? Because now we have several listed REITs. When we combine all these three, the rental yield, the capital appreciation, the reset of rentals, how good has the return been from these products, say, over the past 2-3 years?
Yeah, so I think it's important to sort of look at different time frames because clearly the last 1 year has been fantastic for REITs. But the period before that, because REITs first got listed in 2019.
That was the first REIT.
That was the first REIT.
Brookfield.
So it's, that was Embassy.
Embassy REIT, yes.
Right.
Yes.
And it's been about 6 years now. So it's been through these cycles. So when Embassy got listed, there was this shortage of REITs. It was the only one there. It suddenly saw a big move up. And then you went through COVID, you saw people work from home. A lot of people believed that, that's the future.
And
no
there's
one's going to go back to
never
commercial
return
space.
to office.
Never going to return to office. So you went through this period where, REIT returns were very subdued.
Yes.
You had interest rate cycles along the way as well. So I think, if you look at investors who've remained invested for long periods of time, their returns are quite normal.
And what does that mean? Define
So they've been
normally.
anywhere between 11 to 13% for long periods of time.
Okay.
Which is pretty much how the combination of rental yield plus the rent increase plus capital appreciation's been. But anyone who's come in the last 12 months has seen an abnormally high rate of return.
Absolutely.
And I think it goes back to the principle saying that, a REIT is also a long-term investment asset. And therefore, when you're buying into a REIT, even though it's income producing and therefore there is a tendency to believe it's more like fixed income than an equity asset, I think the time frame definition is really important. And therefore, getting into REITs with a 7 to 10 year horizon probably is a good idea for investors because they'll go through these interest rate cycles. Typically, interest rate cycles last for 2 to 3 years on the way up. Then they remain flat for 2-3 years, then they go down for 2-3 years. So you go through the entire cycle and you'll probably get a normalized rate of return.
Okay, so let's establish reasonable return expectations from this product first. Ashish, like Vishal is saying, that if you just normalize COVID onwards, the slump and the rise, and what history tells us is between maybe 11 to 13%. Now, we can't extrapolate past returns into the future. Right. But would it be reasonable to expect 13 to 14% kind of a return from REITs, say over a 5 to 7 year period?
See, I would peg it more at 11 to 13, right?
11 to 13.
If you get anything higher, I would say it's a bonus. Because look at it this way, right? And I'm just comparing it to stocks because it's easier for your viewers to understand, right? So if you take a stock, right, there is an earnings underlying a business, right? And typically your dividend yields are closer to 1 or 2% in stocks in India right now. So bulk of your returns come as capital appreciation. But in a REIT, what happens is that a large part of your returns come in the form of income, and some part comes in the form of capital appreciation.
Yeah.
Right? Capital appreciation comes because of rental reset plus cap rate compression. So just to give you a maths, 1% lower interest rates results in a 10 to 12% gain on the capital front. So part of the return, capital gains, has lower taxation, as you know. It's 12.5%.
12.5%,
Right?
yeah.
Now, the other thing to consider is how are you getting the income from the REIT? So
And how is it going to be taxed? That's really important.
Right.
Let's understand that.
So there are two ways the REIT
Yeah.
pays out income. One is dividends. There are some REITs which pay out more dividends. For example, Mindspace pays out more dividends.
Okay.
There are some REITs who pay out more interest income.
Okay.
For example, Embassy.
Okay.
Right? So return from interest income is taxed at MMR.
Your maximum marginal rate.
Maximum marginal. So for a person who's at the highest slab, it doesn't make sense. For a person who has a lower slab, it probably makes sense. But for a person at a higher slab, it makes more sense to get dividends.
Okay. And how are those dividends being
So dividends in your hands are tax-free.
Okay.
Right?
Okay.
They're taxed at the REIT level,
Okay.
which is lower than interest income at the marginal rate.
Okay.
So for people at the highest tax rate, probably the dividend makes a lot of sense.
Okay. And then there is capital appreciation, which is capital gains tax.
Which is capital gains tax. So the blended taxation is much lower than fixed income instruments. So the way to look at a REIT is on one side you have a fixed income instrument, right, which is giving you guaranteed income or certain income.
Yeah. Yeah.
And on the other side you have equities which are obviously uncertain depending on the earnings of the companies. This is a hybrid asset class in between.
Okay.
Because about 60-70% of the income comes from dividends or interest, and about 30 to 40% comes by way of capital appreciation.
Okay, got that. So now we've understood the brass tacks. We need to take a break, but after the break, we boil down to further specifics. There are 5 different listed REITs. They own different kind of assets. Like Ashish explained, some give you more interest income, some give you better dividends. How do you decide which one is right for you? And then we also look at changing regulations. SEBI has turned a far more favorable eye to REITs. What does that mean for us? We'll find out after the break.
Let's talk money